Banks are businesses built on a simple idea. They take in money and lend it out. Their goal is to make a profit while managing risk. Risk is the chance that they will not get their money back. To manage this risk, they look for predictability. They want to be as certain as possible that a loan will be repaid. This search for predictability leads to a simple, often difficult, truth. They prefer to lend to people who already have money. This might not seem fair. It often isn't. It is a quiet logic with loud consequences. This preference isn't born from malice. It's a practical response to lending's core business. A person with money with assets with a stable history presents a clearer picture to a lender. They are a known quantity. Their financial life has a track record that can be read and analyzed. The bank can see a pattern of stability. That pattern suggests the future will look like the past. In finance, where uncertainty is the enemy, predictability is extremely valuable. It's why borrowing is smoother for those who've already traveled the path. Lending is a story of who appears safe. It's about who can provide the clearest assurances. Three main factors help create this appearance of safety. First, collateral. Example, a physical guarantee against loss. Second, reputation. Example, the track record of a person's financial promises. Third, network effects. Example, advantages that come from knowing the right people. Together, these three elements build a profile of a borrower. If someone lacks them, the story is uncertainty. Banks may hesitate. We'll explore these pillars. We'll show how they work in simple, real-life terms. We'll see how they benefit those with wealth. We'll see the effect on people who start with less. The system tends to reinforce existing advantages. This matters for fairness and equal opportunity. It quietly shapes who can buy a home, who can start a business, who can build a better future. Understanding this logic isn't about blame, it's about gaining clarity. Section 2. The foundation of safety. Why collateral comes first. The first and most straightforward reason banks favor those with money is collateral. Collateral is a form of security. It is an asset that a borrower pledges to a lender in case they cannot repay a loan. This asset acts as a safety net for the bank. If the borrower defaults, the bank does not lose everything. It can take possession of the collateral and sell it to recover some or all of its money. The most common forms of collateral are things of clear value. A house, a piece of land, a paid-off car. By securing a loan with such an asset, the borrower dramatically reduces the bank's risk. The loan is no longer just a promise, it is backed by something tangible. This concept is simple, but its effects are profound. When a bank evaluates a loan application, the presence of collateral changes the entire equation. The question is no longer solely about the borrower's ability to pay. It also becomes about the value of the asset they are pledging. If the asset's value is high enough to cover the loan, the bank feels much more secure. This security allows the bank to offer more favorable terms. The interest rate might be lower, the repayment period might be longer, the loan amount might be larger. The borrower with collateral is seen not just as a person making a promise, but as a partner in a well-secured transaction. This makes the decision to lend far easier for the bank. Imagine two individuals, Maria and David, both wanting to borrow $50,000 to start a small business. Maria owns a small plot of land that is fully paid for and valued at $60,000. She offers it as collateral. David has a solid business plan, but owns no significant property. He is a renter and has no assets to pledge. From the bank's perspective, the loan to Maria is a much safer bet. If her business fails and she cannot make the payments, the bank can take the land and sell it, likely recovering its entire investment. For David, if his business fails, the bank has little recourse. Its money is simply gone. This difference in risk perception has real-world consequences. The bank is highly likely to approve Maria's loan, and probably at a competitive interest rate. David, however, faces a much harder path. He may be rejected outright, or, if he is approved, the bank may charge him a much higher interest rate to compensate for the greater risk. Section 3. The weight of a promise. Reputation as a predictor. Beyond physical assets, banks place immense value on a borrower's reputation. In the world of finance, reputation is not about character in a general sense. It is a specific and measurable history of financial behavior. It is your credit score. It is your record of paying back past loans. It is the stability of your income. It is your employment history. A strong financial reputation tells a bank that you are a reliable person who honors their commitments. It suggests that you have managed money responsibly in the past, and are therefore likely to do so in the future. This history of reliability serves as a powerful predictor, giving the bank confidence that lending to you is a safe and predictable venture. People who already have money often find it easier to build and maintain a strong financial reputation. Their journey often includes early access to credit card co-signed by a parent's small car loan. By making regular on-time payments on these initial debts, they begin to build a positive credit history. Their steady, well-paying jobs provide a stable income, which is another key component of a good reputation. Each on-time mortgage payment, each paid-off credit card bill adds another layer to this foundation of trust. Over time, they accumulate a long and detailed record that paints a picture of dependability. For a bank, this detailed history removes much of the guesswork from the lending decision. Sarah comes from a family with some financial means. She had a credit card in college. She has been paying her own bills from a salaried job for 5 years. Her credit report is clean and shows a consistent pattern of responsible borrowing. Tom comes from a lower-income background. He has worked jobs that paid in cash. He never had a credit card or a formal loan. He has always been responsible with his money, but he has no official record to prove it. When they both apply for a business loan, the bank sees Sarah as a known quantity. Her reputation, documented in her credit file, speaks for her. Tom, despite being just as capable, presents a puzzle to the bank. His financial history is a blank slate, or what is sometimes called a thin file. Section 4. The power of connections. How networks open doors. A third, more subtle factor is the power of network effects. This simply means who you know matters. People with wealth are often part of social and professional circles that include bankers, lawyers, accountants, successful investors. These connections are not just for socializing, they provide access to information, advice, opportunities. A casual conversation at a golf club, a parent-teacher meeting, can lead to a warm introduction to a commercial loan officer. The borrower stops being a file on a desk and becomes a person vouched for by a trusted contact. Networks provide more than introductions, they provide a support system. A wealthy person might have an accountant who prepares immaculate financial statements. They might have a lawyer or a friend on a bank's advisory board. These resources help package the borrower and their project professionally. That polished presentation reduces the bank's workload and increases its confidence. It makes saying yes easier. Imagine two people trying to get a loan for a real estate venture. One is Chloe, her parents are successful business owners. The other is Alex, the first in his family to try this. Chloe, through her family's connections, gets a personal meeting with a senior vice president at a regional bank. Alex starts from scratch. He downloads forms and fills them out to the best of his ability. He doesn't know any bankers personally, so his application lands in a general queue, reviewed by a junior officer he has never met. He makes a small mistake on one form because he doesn't have an expert to guide him. While his project may be just as viable, the process is harder for him. The bank sees an unknown individual with a less polished application. That perceived difference can be enough to tip the scales. Chloe gets the loan. Alex gets a letter of rejection. The difference was not the project's merit, but the network that surrounded it. When we combine the power of collateral reputation and networks, we see the emergence of a powerful feedback loop. This loop tends to make the wealthy more creditworthy, and the poor less so over time. It is a cycle that can amplify initial advantages or disadvantages across a person's lifetime. Someone who starts with assets like inherited property can use that collateral to secure their first loan. By making the payments on that loan, they begin to build a positive financial reputation. The success of that first venture made possible by the loan may introduce them to new and more influential people, strengthening their network. With a strong reputation and valuable collateral, they can access larger loans at lower interest rates. This cheaper capital allows them to invest in more assets, such as buying more property or expanding their business. These new assets can then be used as collateral for even larger loans in the future. Their growing network brings them better deals and timelier advice, further reducing their risk and increasing their chances of success. Money, in this system, truly begets more money. More accurately, access to capital begets greater access to more capital. The path to building wealth becomes smoother and wider with each successful step. On the other side of the divide, a different kind of loop takes hold. A person who starts with no assets has no collateral to offer. This makes their first loan incredibly difficult to secure. Without that initial access to credit, it is nearly impossible to build a formal financial reputation. They may be perfectly responsible, but the system has no way of seeing it. Their social and professional networks may not include people with financial influence who can offer guidance or open doors. This lack of resources creates a vicious cycle. They cannot get a loan because they have no collateral or reputation, and they cannot build collateral or a reputation because they cannot get a loan. This downward or stagnant spiral makes it incredibly difficult to escape a position of financial disadvantage. Any credit they can obtain often comes from less reputable sources at punishingly high interest rates. The hidden logic of lending is not just an abstract economic theory. It has real, tangible consequences that shape the lives of millions. These consequences touch the most fundamental parts of life: where we live, the work we do, the opportunities we can give our children. When a family can't secure a mortgage because they lack a down payment to use as collateral, or because they have a thin credit file, they're often consigned to a lifetime of renting. They miss out on the primary way most families build wealth and stability: homeownership. Month after month, year after year they pay, without ever building equity in an asset of their own. This outcome can affect a family's financial security for generations. The impact on entrepreneurship is just as profound. A brilliant small business idea can die on the vine when its creator lacks the financial standing to get a startup loan. Imagine a talented chef who wants to open a small neighborhood restaurant. She has the skills, she has the passion, she has a solid business plan. But without personal assets to pledge as collateral or a long credit history, banks may label her too risky. The community loses a business that could have created jobs and become a vibrant, local gathering place. The chef may remain stuck in a low-wage job, her potential unrealized. This story repeats itself countless times, a massive loss of economic dynamism and personal fulfillment. The consequences ripple outward, affecting education and social mobility. Access to loans can determine whether a student can attend a university that best fits their talents, or whether they're limited to a cheaper, perhaps less effective option. It can determine whether someone can take time off for retraining into a higher-paying field. Each denied loan due to lack of existing wealth can close a door to opportunity. These are not isolated events, they are systemic outcomes that pattern our society, reinforcing existing inequalities and making it harder for talent and hard work alone to succeed. This is why the issue matters for fairness. A system that gives cheaper, easier capital to those who already have it, while placing higher barriers in front of those who do not, is not a level playing field. It creates a society of insiders and outsiders. The insiders, through no special virtue, receive tools to build and protect wealth. The outsiders, through no special fault, are denied those same tools. Remember, this is the logical outcome of a risk-averse system, which means changing outcomes requires changing the rules of the game. Recognizing the inherent inequality in this system, banks, governments, non-profit organizations have made efforts to bridge the gap. These interventions create alternative pathways to credit for those excluded by traditional lending logic. One common tool is government-backed loan programs. Small Business Administration, Federal Housing Administration, government insures part of the loan. If the borrower defaults, the government covers the loss, not the bank. That public insurance reduces bank risk, making banks more willing to lend to borrowers with less collateral and to those with shorter credit histories. Beyond government programs, other institutions serve these communities directly. Community banks, credit unions. Their business model relies on deep local knowledge. A credit union loan officer may not just check a credit score. They may know the borrower's family, their employer, and their reputation in the neighborhood. This soft data is based on relationships and personal knowledge. It lets them make loans large centralized banks would reject. Supporting these smaller institutions fosters lending that values character and community ties alongside financial metrics. Financial technology, or Fintech, is emerging as a force for change. New companies use alternative data to assess creditworthiness. Some Fintech platforms specialize in microloans, very small loans to help people in developing economies or in underserved communities start tiny businesses. These innovations are slowly chipping away at the old model, showing more inclusive ways to predict risk. But none of these interventions is perfect. Government programs can be bureaucratic and slow. Community banks may have limited capital and can't make very large loans. Fintech can raise concerns about data privacy and algorithmic bias. The challenge is balancing innovation and access with ensuring the banking system remains stable and safe. Good policy finds a way to do both. Encourage new risk assessments while maintaining protections for lenders and borrowers. The goal isn't to eliminate risk, that's impossible. It's to distribute risk management more equitably, so opportunity isn't only for the wealthy, We have seen that banks operate on a clear and consistent logic. They are in the business of managing risk, and to do that, they seek predictability. This search for predictability leads them to favor borrowers who can offer it. People who already have money do this through three main avenues. They provide collateral that secures the loan. They have a long and documented reputation for financial responsibility. They are often part of networks that smooth the lending process. This is not a conspiracy. It is the rational, predictable behavior of a system designed to protect capital. But the consequences of this logic are not neutral. They create a powerful feedback loop that makes it easier for the wealthy to borrow and harder for the poor. This system has a profound impact on the shape of our society. It affects who can buy a home. It affects who can build a business. It affects who can invest in their own education. It creates a gap between those with access to affordable capital and those without. Over time, this gap can grow into a chasm, widening inequality and limiting social mobility. The message is not that banks are villains. The message is that the system, if left to its own devices, will produce unequal outcomes. It is a machine that is very good at doing what it was designed to do, making safe bets. The problem is that the safest bets are often those who need the help the least. Understanding this hidden logic is empowering. It moves the conversation away from simple blame and toward a more constructive analysis of the rules of the game. If we do not like the outcomes, we have the ability to change the rules. We can strengthen government programs that share risk with banks. We can support community-based lenders who use local knowledge to make smarter, more inclusive loans. We can encourage new technologies that find fair and innovative ways to measure a person's reliability. We can invest in financial education to help more people learn to navigate this complex system successfully. Each of these is a concrete step toward a fairer system. In the end, we are left with a simple choice. We can accept a system where access to opportunity is largely determined by the wealth one already has, or we can decide to consciously and deliberately build a system that is more inclusive, a system that recognizes potential, not just pedigree, a system that finds ways to say, yes, to more people who are willing to work hard and take a calculated risk on a better future. The logic of lending is powerful, but it is not destiny. By understanding how it works, we gain the power to reshape it. Predictability drives lending, but our shared values should drive policy. We have the knowledge and the tools to make access to credit fairer. The choice to use them is ours. If this clarified banking logic, please like and share. Banking logic. Chat your credit access. Chat your hidden rules.